Good morning and welcome to The Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Let's check out some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney is heading to New York this week. The trip includes meetings with investors, CEOs, entrepreneurs, and business leaders. According to the Prime Minister's office, Carney will also deliver remarks at the Economic Club of New York on Thursday, where he will outline Canada's new economic strategy and the progress made so far. The trip comes weeks before the deadline to review CUSMA, which is July 1st. Pembina Pipeline is going ahead with a new natural gas processing facility in Alberta. The Heartland extraction plant has an estimated cost of about $570 million. Should start up in late 2029. Following extraction, the ethane mix will be processed at Dow's Fort Saskatchewan facility in Pembina's Redwater complex. Tim Hortons is launching a campaign to recruit local team members as the number of temporary foreign workers in its restaurants declines. The coffee chain says, in light of high youth unemployment, lobbying for increasing access to foreign workers is no longer necessary. The newly launched hiring spree comes days after the Toronto-based company said it will expand with 80 new restaurants and 400 others undergoing major renovations. And a quick look at the markets, and you can see the TSX hovering right around record territory after closing up on Friday. See what happens with it today. Of course, the American markets will be closed today. Oil right now, no surprise on that news out of the Middle East. The talks maybe are progressing. There's reason for optimism. It is off about 5%, a little more than 5%, and down below 92, just split between 92 and 91 a barrel. Gold, it is reacting as well. It's up by 0.88% and pushing that $4,600 an ounce mark. As for the dollar, it is up ever so slightly at 72.43. Let's take one quick look at Bitcoin, see what it's doing right now. And Bitcoin also reacting on the news out of the Middle East, up by nearly a full point at a little more than 77,000. It is a big week for Canadian banks, with all of the big six reporting later this week. Bank stocks are up 16% so far this year. The TSX is only up 9%. Joining us now is Alexander McDonald, portfolio manager at Focus Wealth Management. Alexander, thanks very much for joining us.
Good to see you, Roger.
All right. What are we expecting from the banks? They've had another gangbuster year so far.
Yeah, the banks are coming fast and furious this week. We have BMO, Scotia, and National reporting before the open on Wednesday, and the remaining three of the big six reporting before the open on Thursday. As you mentioned, they've had a great year. That has caused valuations to expand a little bit, though. They're up as a whole, trading at just over 15 times forward-looking earnings versus the 10-year average of about 11 times. That's the group, but within the group, there's actually a bit of divergence from the low end of 13 times up to the high end of just under 17 times. And what's driven that divergence has been the nuances of the businesses that the banks are participating in to greater or lesser degrees than their competitors. So there's two main businesses that I think are going to be topical this week as the banks report. The first one is capital markets. That's been a huge tailwind for the banks, not just over the short term. 25% of earnings revisions recently have come from the capital markets side of things, but over the long term. Since 2019, the capital markets business has grown 10% annually for the banks. So banks that are overweight the capital markets side, National comes to mind. They have done especially well recently, and National is actually at the high end of the valuation within the peer group. The other big part of the bank's business that I think is going to be topical this week is on the consumer lending side, specifically personal lending in Canada. The Canadian economy is doing okay. It's not doing great. We're starting to see unemployment tick up right around 7% now. We're starting to see credit card delinquencies tick up. Consumer proposals are increasing a little bit too. Of course, the housing market is down about 20% from its 2022 highs. So with energy prices increasing from what we've seen with the conflict in the Middle East, it's going to be interesting to hear what bank management teams are saying about the environment, saying about the lending environment to Canadian consumers. I think we're not going to see for the next little bit significant mortgage growth. because of those headwinds that I mentioned earlier, but we might see net interest margins expand at the banks as that yield curve steepens and they can lend out their mortgages at a higher rate than what they have to pay for deposits on the closer side of the yield curve. So those are two things I'm going to be looking at this week, and we'll find out in a couple days what is topical from the bank's point of view.
And just going back to the capital markets, you said National's really benefiting. Any of the banks not doing as well in that sector, and are any potential headwinds there?
Yeah, National, as I mentioned, they're overweight specifically on the equity and derivatives trading side compared to some of the other banks. So traditionally, the banks were very strong in fixed income, commodities, and currency trading. That's shifted in recent years. Since 2019, I mentioned that overall capital markets revenues have grown. Equity capital markets has actually grown at about 12%, and that fixed income side has only grown at about 9%. So because National is more overweight, the equity side, you've seen that stock do very, very well. The downside of that is capital markets revenues can be very volatile. We know, looking back over the last 3 months, that we have seen volatility in the equity markets. So that's good for the banks and their capital markets business. But that doesn't last forever. If we do have periods of lower volatility in the markets, that won't benefit the bank's capital markets, specifically the Nationals of the world that are exposed to the equity side of things as much. So in one of the two names that we own at Focus, I can talk to in a little bit, they're a little bit more underweight the capital markets side of the business, and a little bit more diversified, and that's Royal, and we can chat about that in more detail.
All right, well, let's talk a little bit about Royal. I mean, it's the beast, it's the big one, isn't it?
Yeah, so it's actually been a bit of a laggard, even though 3 out of the last 4 quarters it's beaten on ROE compared to what analysts were looking for. And the reason it's lagged the Nationals of the world is because it is more diversified with its business model. It is generating those high ROEs, but it's not participating in the upside on the trading side as much as some of its competitors. That said, I did mention that capital markets revenues can be volatile, and I think if some of that activity does come off, some of the shine comes off some of the banks that are more exposed to that, you might see investors gravitate back towards an RBC, which does have a very good diversified business model across lending, capital markets, the corporate banking as well too. Its valuation is on the higher end of the group, but National is still trading higher than it. And we think it's at a reasonable level right now, and we're happy to hold it over the long term.
And Bank of Nova Scotia, it's doing a strategic reorientation. What are you going to be looking for with that this week?
Yeah, Scotia's the other of the big 6 banks that we own. As you mentioned, a bit of a strategic reorientation. New management team came in a couple of years ago to really focus in on the North American market. It was previously pretty well diversified across Latin America. But more recently, it's really had a laser focus on its Canadian lending business. If you look at the ROE, the return on equity it's generating there, it's about 16%, which is below management's target of 24%, and the peers as well, they're up around that level as well too. So Scotia's been very, very focused on making that a priority to get that Canadian banking segment in better shape. You're starting to see some green shoots there. Their fee-based income on the Canadian banking side has increased in recent periods. As well, management has said they want to be more aggressive bringing on new clients. Obviously, it's a very competitive market, but you had a lot of borrowers that have ultra-low rates from the 2021 cohort when mortgage rates were super low that now have to renew in 2026. So those are potential new customers that Scotia can go after and increase their loan book that way. And in addition, its valuation, that's part of the attractiveness with it too. It's just trading over at 13 times, which is the lowest of the group. And we think that is a reasonably cheap valuation for a bank the quality of Scotia's.
All right, I just want to get one last question in with the fintechs like Wealthsimple, Questrade. Concerns from the banks there? Are they taking a bigger bite of the pie?
Look, it's great I'm a Canadian, it's great from a consumer's point of view to have more competition out there in the financial industry. It's good to see somebody going up against the big banks to make them evolve and innovate with their offerings as well too. You start to see the products that banks will offer you will mirror Wealthsimple if you see Wealthsimple taking customers. Over the long term, I don't think it's going to take a huge bite out of the bank's business. I mean, it's an oligopoly. It's been an oligopoly for the longest time. Incredibly strong banks. They survived the financial crisis in 2009 when U.S. banks, a lot of them didn't. It's a pillar of the Canadian economy. They will innovate. They'll make things better for customers, but I don't think it's going to be a material disruption going forward for the big.
All right. We'll wrap it up there, Alexander. Thanks very much for joining us.
Thanks for having me.
Alexander McDonald, Portfolio Manager at Focus Wealth Management. Coming up, as investors await what will be the biggest IPO ever, our next guest is ringing the alarm over governance issues for SpaceX and has a list of concerns about the company's structure. New York City Comptroller Mark Levine says that New York will be a major shareholder in SpaceX due to indexing. He's also worried about the governance concerns over the SpaceX IPO. He talks about the potential legislative changes that could be made to curb these mega IPOs. Now, earlier we got perspective from him in a Bloomberg interview, and he began by explaining why Elon Musk will simply have too much power.
I'm okay with founders who want to exert control. I get that. But what Elon Musk is doing here is taking it to a whole new level. This level of control, dominating shareholder power, no independent board, occupying both the CEO and chairman's role at the same time, really eviscerating shareholder rights to sue and take other actions. And I represent shareholders. We have a $325 billion pension fund. We probably have $80 billion plus in indexing. So we're going to be a major shareholder in SpaceX. And I think that efficient capital markets require democratic governance and transparency, and it appears we're not going to get that out of SpaceX.
The letter that you sent, it also included the heads of a couple of other pension plans. And I do wonder, is there any sort of regulatory or legislative change that could be made to address, and this has been a growing problem for a while. We had a lot of the same concerns with Tesla, and it's not just Elon Musk. There have been other sort of tech companies out there where the founders have had outsized voting power and power over their boards in a way that basically meant that if you were a shareholder, certainly a passive shareholder, you basically had to take whatever they gave you.
Yeah, this is a trend in Silicon Valley. Of course, we'll see it with Meta, et cetera, and Google to some extent. But this is going way beyond what we've seen in those companies. And so, yes, I've joined with the state of New York comptroller and the head of the largest pension fund in California. We have $1 trillion in assets combined. And so we're making our voices heard. We are presumably all going to be major shareholders after the IPO, and we're going to continue to be active. As for regulatory help, it does not seem that that's coming certainly during the Trump administration. So I think it's on us as major shareholders to speak up for our employees and retirees, and also millions of shareholders around the company who also are going to have money in index funds, retirees in the private sector, and they deserve democratic corporate governance as well.
I do want to ask you just about kind of the overall trends right now that we're seeing right now with artificial intelligence. I mean, by almost every objective measure, this does seem to be like one of these big transformational moments in our economy, in our society. There's going to be good with that, but there's also going to be bad. And I do wonder as to, particularly in your role, how you find the balance.
Look, this is very much a New York story. I think more than people realize, our economy is tied up in New York City with the financing of AI, so we've gotten a huge upside from that. In the last few years, we are financing the data center boom, among other things. Also, this is the capital of white-collar work. We have 1 million people who come to office buildings every morning in Manhattan, careers that are very exposed to AI. So depending on where this goes, we could get an enormous economic boost, or we could pay a real price. And my office actually issued a report today where we looked at 5 scenarios ranging from very good to very bad. Whether we have an AI bubble burst, whether we have an actual supercharge in productivity that benefits the city more broadly, whether we lose jobs. We're not even having this discussion right now in local government. We're not doing anything to prepare. And we're headed into unknown territory.
What's the potential scenario? I mean, when we talk about white collar, and let's just take finance, because, I mean, there's been a lot of talk, particularly with a certain research job, certain types of investment banking jobs, the idea that you could maybe potentially replace some of those human beings with whatever the AI tools are. Maybe that's not right now today, but most people think that will be very close in the future.
I think we might already be seeing it, and we have some data in New York that is very interesting. For the first time ever, the unemployment rate among young people in their 20s in New York City is higher for those who have a college degree than those who do not. We've never seen that in the data, going back decades. That, to me, can only be explained by the fact that companies that have white-collar workers are slowing down, bringing on entry-level talent. This is an early sign of what could be accelerating. By the way, talk to any person in their 20s in New York City. Breaking into the job market is brutal right now, and I think this is partly what's driving that. I expect it to be accelerated. What are the most exposed sectors? It's finance, it's accounting, it's business services, it's media. Those are the pillars of New York City's economy. Right. So we here need to have a plan to deal with this. If we take a hit to our budget, if we have a lot of unemployed people, and the plan I put out today calls for us to start to build up a reserve fund so that we can handle that uncertainty when it hits.
With regards to that reserve fund, are we talking about something that would be temporary in nature, or are you talking kind of long-term, almost endowment-like, if you will, to sort of supplement what gets lost?
Yeah, it's almost like a sovereign wealth fund for New York City. We have a mechanism. We have a rainy day fund. It's very tiny. It's only about 2 or 3% of our total tax revenue. It's not going to be enough to get us through the kind of turbulence that I'm talking about.
Is the mayor on board with this?
I hope so. We're pushing hard. It's not easy because we need to get the money. I'm going to be fighting for this. Our budget's due in June. This is going to be a major theme for me between now and then and beyond.
Well, when we talk about sort of preparing New York City for what the future might be, how real do you think this threat is compared to the multitude of threats? I mean, it seems like every 2 years somebody says, New York City is over. All the people in Wall Street are moving to Florida. You had the COVID pandemic. You had this, that, and the other here. Why should I take this more seriously than all those other threats, which we now know, at least long term, did not sort of end up being the bust that we thought?
You're making a really good point. And to your viewers who are not in New York City, who think this is a hellhole right now, New York City's booming by almost any measure. Commercial real estate leasing is on a tear. The best it's been in 20 years. We had 65 million tourists here last year. You can barely walk in Times Square right now. Crime is dropping here in many, many ways. Demand for luxury housing, for all housing, is off the charts. Rents, off the charts. As of today, May 21st, 2026, we're doing well. We've overcome the naysayers again and again. But I think that AI needs to be seen as unprecedented. And yeah, we did great in the internet boom. New York City has thrived since the internet boom. But I don't know. We don't know. We could see another boom built on this. If we are the capital of AI, applied AI, we continue to finance this. But we have to be ready for the downside. We're not, and I put out my report today to sound the alarm.
Do you have confidence, if I brought you back a year from now, that we'll be prepared?
We are very far behind right now. This is not a major topic, even of discussion in local government. Maybe we're hoping on the federal government to save us, but I'm not optimistic about that. Cities need to start taking charge because cities are on the front lines of this because of the nature of office work. And I'm hoping we can lead the way in New York.
All right, that was New York City Comptroller Mark Levine. The CRTC says the new rules will increase the amount of revenue Canada earns from streaming services, but the change is quite controversial. CTV's Jeremy Chiron filed this report.
It's a move that will push global streaming giants like Netflix and Disney to pay up.
They are going to push back on this to the fullest extent, both on the trade side and the legal side.
This week, the Canadian Radio, Television and Telecommunications Commission unveiled new rules aimed at modernizing Canada's Broadcasting Act, increasing the amount of Canadian revenue these companies need to put toward Canadian content from 5 to 15%.
The CRTC has thrown a Trump trade hot potato right into the lap of the Prime Minister.
In a social media post, the U.S. ambassador said the decision is making a bad situation worse, accusing the CRTC of putting up new discriminatory trade barriers. While the Motion Pictures Association, which represents the streaming giants, claims the move violates the free trade deal between Canada and the U.S. and calls the rules unprecedented, unnecessary, and discriminatory investment obligations.
First of all, how loud is Trump and the White House going to get? And second of all, how much does the Prime Minister care? Is he still in a mood where he wants to move quickly if Trump expresses exasperation? Or is he more of a fighting mood these days?
Since the CRTC first required the streamers to pay 5% in 2024, no money has actually been collected as the streaming companies have challenged it in court. The Trump administration has repeatedly pointed to this policy as a trade irritant.
They are going to use this as leverage in the most integral way possible when it comes to that renegotiation.
The same CRTC decision also lowered the percentage Canadian broadcasters must pay to reinvest in domestic content from as high as 45% to 25%, as they continue to compete for revenue and viewership with streamers. The Minister of Canadian Identity and Culture, Mark Miller, says the government is reviewing the CRTC's decision and carefully assessing its impacts.
And that was CTV's Jeremy Sherrill. Up next, how FIFA costs seem to keep rising. Well, as the World Cup fast approaches, the costs seem to only keep rising. It's estimated it will set Canadian taxpayers back about $1 billion to host the FIFA World Cup, or at least some of the games. Is it worth it? CTV's Andrew Johnson has more.
Predicting whether a host city will end up a winner or a loser after an event like the FIFA World Cup can be a game of perspective. Host politicians often provide the most positive outlook, as we have seen in the past in both Toronto and Vancouver.
It will put Toronto on the map. We are literally going to get the equivalent of 30 to 40 Super Bowls in the city of Vancouver over the course of a month.
At the opposite end of the prediction playing field are sports economists like this one.
The mayor of Vancouver is bordering on criminal behavior, not criminal in the sense that he should go to prison, but criminal in the sense that he continues to double and triple and quadruple down by promising these benefits that I have been saying for 8 years as an expert, they're not going to happen.
The latest round of debate was kicked up this week by a report from Canada's budgetary watchdog that to host 13 games as of now will cost taxpayers $1 billion, a figure that has ballooned since the original bids.
It's going to be higher, and the real number is going to come out in August and September when everything is done. That's just the way it goes.
According to Taisha Redden, an expert in urban planning from the University of Toronto, the way it goes is host cities almost always lose money, despite seeing a post-event tourism boost. She says it's happened at 12 of the past 14 World Cups.
The data has borne out over years, decades, and geographies that these events very rarely, if ever, meet these projected revenues.
But in the short term, she says bringing the Olympics or World Cup to town does provide big political gain.
It's a great photo op. It's a great vanity project. It's a great way to push through some capital infrastructure if you have projects like that in mind.
Redden thinks on a global scale, we need to radically rethink the bidding process for international events, and organizations like FIFA should be picking up more of the tab. Andrew Johnson, CTV News, Vancouver.
All right, opening bells are next. All right, time for the opening bell. Not quite the cacophony you're used to. Holidays south of the border, of course, so markets there are closed. But the TSX is opening today, and Hamilton ETFs opening the market. Hamilton Capital Partners is pleased to announce the launch of 2 new yield maximizer ETFs, Hamilton Canadian Equity Yield Maximizer ETF, CMAX, and Hamilton International Equity Yield Maximizer ETF, IMAX. It is time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity market and see what is happening today. Look at that jump, putting the TSX well into record territory to start the day, up by 3/4 of a point right now. And let's see what sectors are moving it right now. Just taking a quick boo here. And comms, utilities all up today. So we'll see what happens with that. But a lot of this is in response to what's unfolding in the Middle East. But you can see right now, the TSX, an intraday high at 34,726. And a couple of stocks we're keeping an eye on. Look at this. BlackBerry today up another 4.8%. And it is on a bit of a tear right now, and rising to its highest level since 2022 last week after Major U.S. government security certification milestones were met by it, and it's having a little bit of a renaissance. So we'll see where that goes. And gold is where we're going now. And it's up right now, right around the 4,600. It's been around there. It's up a little under a point right now and been hovering around that 4,600 mark all morning so far. Oil, no surprise, expected to be dipping right now. And yeah, it's WTI off by 5 1/4 points on the news out of the Middle East. That there is the possibility there may be either an extension of the ceasefire or even more enduring ceasefire between Iran and the U.S., but we'll have to see what happens with that, of course. And it's the holiday south of the border. All right, we're going to take a quick break. When we come back, our next guest says, despite stocks being near all-time highs, markets remain range-bound as investors wait to see what higher energy prices will mean for inflation. That's next. Alberta's possible separation referendum question continues to draw feedback from Premier Smith. CTV's Jeremy Sherrill filed this report.
It's a fall referendum vote Alberta's Premier hopes could put an end to a decades-long debate.
We do need to get this issue resolved so that we can come to a conclusion and we can move on from it.
But that isn't exactly how everyone sees it.
Seems like Daniel Smith's trying to make this happen one way or another.
Daniel Smith will not stand up and say, just stop it, because he's all part of this whole cabal.
The Premier insists she's simply respecting democracy, allowing Albertans to decide what happens next.
I respect the grievances that there are in Alberta, but I certainly hope that Canada can overcome them and show that we are the place they want to be.
It's upsetting because I would like Canada to stay together.
Smith says that's what she wants too, for Canada to stay together. And speaking with CTV's Question Period host Vashi Kapelos, the Premier made this commitment.
If the Remain side does win, do you promise, as long as you're Premier, you will not hold a separation referendum?
Yes, I do. I will listen to the will of the people, and that's why I'm going to be advocating on that side. But it goes the other way as well. That if Albertans vote the other way, then we'll have to begin the legal process to get to a binding referendum.
The question being asked this fall is whether Albertans want a separate official referendum on separation. That could trigger another binding vote to leave the country.
It has to be a very simple, clear question.
But even if a majority vote to leave, the path to do so is unclear and would start by triggering something called the Clarity Act.
There's no question of separating under the Canadian Constitution. You have to have the majority of provinces and the Parliament agreeing to your separation. So how would that ever happen?
It would require the Supreme Court's involvement and a negotiated agreement between all provinces and the federal government. And piling on to the complexity, legal experts also suggest a court decision earlier this month to throw out a pro-separation petition for its lack of consultation with First Nations indicates that would play a crucial role in any secession. Jeremy Sherrill, CTV News, Ottawa.
Friday on Market Call, we were joined by Martin Cobb, Senior Vice President, Equities at Lawrence Steinberg Wealth Management. His focus, global and North American equities. His top picks, McDonald's, the Universal Music Group, and Brookfield Corp. Join us today on Market Call is Jamie Murray, President of the Murray Wealth Group. He'll take your questions on global equities. Still ahead, our next guest says, despite stocks being near all-time highs, markets remain range-bound as investors wait to see what higher energy prices will mean for inflation. That's next. Rising oil prices linked to the tensions in the Middle East are pushing new fuel surcharges and food price hikes. While major grocers say they're pushing back, independents warn they lack the leverage and are feeling the pressure as a result. We get more from Gary Sands, Senior Vice President, Public Policy and Advocacy at the Canadian Federation of Independent Grocers.
The food manufacturers that supply the grocers with the products that your viewers, consumers are buying, have been sending out numerous letters, notifications of cost increases that they have attributed, understandably, to rising fuel prices, and they've imposed either an increase in costs or they're putting in place a fuel surcharge. We understand the rationale for that. I mean, anyone who's pulling their car up to a gas station to fill up understands what's going on, and obviously that's impacting the food industry as well. But the problem we're having is that not everyone's getting those notices. In some cases, some of the chains are saying they're not even receiving the fuel surcharge notices, and in other cases, they're saying publicly that doesn't matter if we get them, we're not accepting them, and that should be a concern to governments and should be a concern to consumers in general. That kind of unfair application of increases that are unavoidable are being passed only on to one sector of the retail grocery industry.
Yeah, we've obtained a couple of those letters, and especially some of the timing, that in some cases, right, giving only days notice that something was going to change, that those costs were going to go up very quickly. We know that margins in the grocery industry, even for the big stores are so thin, but especially for independents, I'm assuming that those costs, if the independents have to face them, are going and likely have to be passed on to the consumer.
Yes, I mean, I can't say what all independents will do, because independent means exactly that. They're independently able to make their own decisions, but really they've only got three alternatives. One is to increase prices. The second is to reduce their margins even further. An overall margin of independent grocers is about 2%. So you're getting into very precarious territory there. And the third option is you're looking at having to reduce or scale back any in-store investments, which are necessary to make to keep your business going. It's one of the three. So none of those scenarios are very encouraging or good for the industry or for consumers.
When we look at it too, and in particular for independent grocers, there are a lot of times in smaller communities and in smaller towns that they are the only store. They are the only grocery store. They're the only spot that a lot of people can go to. If we look at those margins sinking, if we look at the costs increasing as much as we're talking about too, is there the possibility that we're going to slowly start to see, and maybe not even slowly or possibly all at once, some of these stores really start to close up shop because they can't face any more increases?
It's a good question, and you're absolutely right. We have about 6,900 independent grocers in Canada, and they're in all areas, urban, rural, remote, but a lot of them are in rural and remote communities where the size of the community is just not large enough to support a chain. So they're the only source of food for the people in that area. So I would just point out too that even before this issue of the fuel, the rising fuel prices due to what's going on in Iran started to rise, costs of transportation for food to those areas in Canada is already higher. And that means the cost of food is already higher in those areas. So the impact of these fuel surcharges and the rising costs is going to be more disproportionately significant in those areas. And I think if you're not talking about, if it's not closures, I think you're certainly treading into the area of food security where, the price of food could simply become unaffordable. And that should, again, be a concern to government. Again, I don't want to point the finger at suppliers. We understand what's driving up their costs, but we are pointing out as loudly as we can that we have to have fairness in how they're applied. And I'll give you just if I can, just a simple example of where there's a disparity in the approach. In on March 31st, Maple Leaf Foods, well known to consumers, sent out a notice to retail grocers notifying them that they would be implementing a fuel surcharge effective April 6th. Now, if you look at the calendar, you'll see that that was really only 3 business days. I can tell you without fear of contradiction that if Maple Leaf Foods sent that kind of notice saying their costs, they were imposing a fuel surcharge and their costs were going up within 3 days, if they sent that to Loblaws or Walmart or Metro, all I can tell you is they'll keep the car running for them in the parking lot while they run in to have that conversation, because it's not going to be a long meeting. They wouldn't accept it. But and Maple Leaf knows that. So really, in essence, what they've done and what others are doing is they're imposing a fuel surcharge and rising costs only on independents. And surely, as a country, I'm hoping that we'll say this is not right.
That was Gary Sands, Senior Vice President, Public Policy and Advocacy at the Canadian Federation of Independent Grocers. Let's head to Ottawa now, where CTV's Michael Couture is standing by with the latest on Parliament resuming for its final session before a summer recess and before Prime Minister Mark Carney heads to New York to pitch Canada as a good investment. Mike, thanks as always for joining us. What is the latest? First of all, Parliament, short one. What can we expect?
Yeah, I think when you consider in the short term, Roger, the focus will be on what's happening out west today, and that is the meeting of Western premiers and some of the territorial premiers as well. We know that Danielle Smith is hosting them in Kananaskis, Alberta, and national unity is now going to be one of those questions that we will be seeing on Parliament Hill, but more specifically out in Kananaskis. We know that David Eby has said some strong things about Danielle Smith, and certainly criticism about how they are getting a lot of the attention, as he has said, and he said it's unfair and Canada doesn't work if all the attention is going to so-called separatist premiers, and how Prime Minister Mark Carney will manage that, and certainly how Pierre Poilievre will try and put Mark Carney on the hot seat for managing that as well. I'm expecting some of that to happen and play out in question period today, especially when you consider it's all around that MOU and the plan towards a pipeline. David Eby saying that BC does need to be at the table and have those types of conversations about it. The Prime Minister continuing to say, even last week, that he doesn't want to hear no from different premiers, and saying that if they can't make something work in one province, well, they're not going to spend a lot of time there. They're going to move on to places where they can make things work. Certainly, there are a number of major projects that the Prime Minister has said he's willing to work with BC on, but really trying to say that this is more about cooperative federalism. That is something that he had mentioned on Friday after Danielle Smith had put that new convoluted question on the table, which she says she will be putting in that referendum in mid-October. So that's what I'm watching for right now, how the federal politicians will be responding to what's happening in Kananaskis today and those awkward moments. And something to note, Roger, is that Danielle Smith has said that she will be gifting Premier David Eby some cowboy boots as a welcome to this meeting. Whether or not he's going to be using them to do a two-step with Danielle Smith, or if those boots will be made for walking right out the door, not sure just yet, but watching out for that one, Roger.
How long have you been waiting to use those two? All right, Mike. The Prime Minister is available today. Media availability, I imagine a lot of conversation is going to focus on that. But with CUSMA coming up, it's the timing, eh?
Yeah, it really is when you consider that he is going to be heading down on Wednesday and Thursday to New York City, a conversation and a speech at the Economic Club of New York City. And, when you consider the fact that he will be talking to business people there. This is not an end around U.S. President Donald Trump, but certainly trying to pitch Canada as an investment destination, saying that Canada has what the world wants, saying that they want to be an energy superpower as well, trying to convince the business community there not to move any kind of investment out of Canada, but rather invest in Canada. And we also know that U.S. President Donald Trump listens to the business community there. So if Prime Minister Mark Carney can can make some headway in that kind of conversation and convincing that it is worth having these discussions with Canada and keeping Canada in that trilateral fold. We know that right now we are about 37 days away from July 1st. That is the deadline for the CUSMA review. Whether or not they're going to continue to move forward on that, that is the question that continues to hang over this. We also know that Mexico and the United States have made a lot of progress in their discussions. Canada and U.S., it's pretty much radio silence right now. Canadian officials not saying much on whether or not there are negotiations or if there's any progress as well. So I think a lot of us will be looking forward to that moment and to hear it as well from the business community there as to whether or not they think that CUSMA is worth saving.
All right, Mike, we have to wrap it up there, but thanks as always for joining us, sir.
Thanks, Roger.
Mike LeCouture from CTV News. Coming up, a look at how AI is eating Wall Street's lunch. Artificial intelligence has been disrupting countless industries, and now it's targeting the center of commerce, Wall Street. BNN Bloomberg contributor John Ehrlichman has a new story out. It's on our website. He joins us now with more on this. And John, perhaps the biggest development recently is with the AI company Anthropic. Thanks all for joining us, sir, as always.
Thanks, Roger. You're right about that. Yeah, earlier this month, Anthropic made a lot of headlines with this basically partnership with a lot of big Wall Street firms around the idea of introducing way more AI tools across Wall Street. Obviously, it raises a big question, Roger, about what it means for Wall Street workforces and Bay Street workforces, for that matter, because a lot of these tools are targeted at some of the stuff on the margins that takes a lot of time and energy, but which AI can do much faster. So if you think about the way these sort of Wall Street firms are structured, you know, there's a senior person. Maybe if they're on the research side, they might have an analyst team with a senior analyst and a bunch of junior analysts who are collecting a lot of data. Well, guess what? What Anthropic is now offering handles a lot of that. So not only are you seeing examples where firms like JP Morgan say, sign us up, we're going to use these tools, we'll pay for them. You're also seeing examples where companies are literally investing in Anthropic, like Goldman Sachs, or creating joint ventures where they're going to take the tools from Wall Street and start putting them into the regional banks as well. Long story short, the financial services industry is going through massive disruption as a result of this, and that's going to be a big question about jobs, et cetera, as we roll along.
Well, yeah, I mean, a lot of those are the entry-level jobs. So who's next? Who's going to replace the people who retire if you don't have people coming in?
Very good question. And I think that the idea, like if you go by what Jamie Dimon of JP Morgan is saying, he's not trying to be doom and gloom, people are going to lose their jobs. We're going to move people around the organization and hopefully find better spots for them. I think this sort of builds into the argument that if we know that there's stuff that's not going to be there because of AI, what is the job of the future for somebody who's young now and going to be in their prime 10 years from now? And then there's the whole ecosystem, Roger, around like everything that feeds into how Wall Street gets information and makes sense of it in the first place. So we already saw the software companies take a big hit this year. When this news came out, a lot of the data providers that feed into Goldman Sachs, JP Morgan, like S&P, FactSet, Morningstar, they all saw their stocks down. Not necessarily because they're not going to be using this data anymore, but they used to be able to, just like software companies, charge a per seat license, and that was very profitable. So now you're going to have a senior analyst who has a bunch of AI agents who go out and get all this information. Wall Street still wants to work with these companies, but they definitely don't want to pay the same amount. So that business is going to be disrupted as well. The banks themselves might end up being more profitable through this whole thing. So there is that part of it as well to watch for anyone who invests in financial services. But for Anthropic, Roger, financial services as an industry is already their second largest customer, and it's a massive one.
And I guess this creates an industry of how to deal with AI within the industry, doesn't it?
Very true. Yeah, because, you know, it's almost like, the innovator's dilemma for a bank. Like, why wouldn't you want to implement AI tools, even though you know that is going to hurt your own workforce? I think every industry is going through that right now. Hopefully, as we go through this process, it will be less dramatic in the moment than some are fearing, and actually will help us to kind of get to sort of new jobs that make a lot of meaningful sense for people in the AI economy. But it's going to be interesting to watch.
Absolutely. And then I guess investors, how are they navigating this? How do you navigate it?
You know, I think just as an example, so take those data companies, S&P, FactSet, Morningstar. They initially sold off, then they started to come back because people realized, okay, Wall Street's still going to use this stuff. It's just that the business model might change. Now, on the software side, we already saw that massive sell-off for some of the companies that basically sell a layer to companies like Wall Street firms. Workday would be an example, like a software company that offers things like HR software and charges per usage. That might not work as well. But we do know there are other software companies, like Microsoft is a great example of a company that has basically embedded AI into everything they do and everything they sell. So even though they took some hiccups this year, there's a lot of people on Wall Street who still think that they are in very, very good shape. So it's almost like looking for the companies that have AI right in their line of sight and are leaning into it in a way that will make them relevant versus compared to the reverse.
All right, we got to wrap it up there, John, but always a pleasure to talk to you, sir. Thank you.
Thank you, Roger.
BNN contributor John Ehrlichman. You can also find a full breakdown on AI's Wall Street push on John's Ticker Tape YouTube channel. All right, let's take a look at some of the notable analyst calls and recommendations for today. Jefferies initiated coverage of Pershing Square with a hold rating, $40 price target, US. The firm views Pershing as a unique investment vehicle with a fee-paying asset under management base that is predominantly in permanent capital. However, at the stock's current valuation, Jefferies sees a balanced risk-reward. BMO Capital raising its price target on Bird Construction to 70 from 60, keeping an outperform rating on the share. After meeting with management, the firm sees multiple verticals driving the company's backlog and margin growth into 2027 and beyond. RBC Capital Markets maintaining a sector perform rating on CAE, noting that while fiscal year 2030 targets are achievable, they fell short of elevated investor expectations. And Bank of America analyst Michael Funk raised the firm's price target on Zoom Communications to 105 US from 90, keeping a neutral rating on the shares. The firm views the company's Q1 report as solid. It cites the strong Q1 results for that boost. And we have more coming up after the break. Stick around. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. The U.S. and Iran are inching closer to a deal to extend their ceasefire and reopen the Strait of Hormuz. Officials from both sides are signaling they still need to negotiate certain points. U.S. President Donald Trump says the deal will either be great or there will be no deal. A spokesman for Iran's foreign ministry says no one can claim the signing of an agreement is imminent. Prime Minister Mark Carney is heading to New York this week. The trip includes meetings with investors, CEOs, entrepreneurs, and business leaders. According to the Prime Minister's office, Carney will also deliver remarks at the Economic Club of New York. On Thursday, he will outline Canada's new economic strategy and progress made so far. The trip comes weeks before the deadline to review CUSMA, which is July 1st. Pembina Pipeline is going ahead with a new natural gas processing facility in Alberta. The Heartland extraction plant has an estimated cost of about $570 million, should start in late 2029. Following extraction, the ethane mix will be processed at Dow's Fort Saskatchewan facility in Pembina's Redwater complex. And a quick look at the markets, and you can see that the TSX is responding to the news that unfolded over the weekend. Right now, it is well into record territory, being driven by materials and tech, industrials as well, and financials. They're all up more than 1%. Only drag is energy, and utilities are off ever so slightly right now as we keep an eye on what unfolds in the Middle East. And of course, the U.S. markets closed for the Memorial Day holiday. And of course, investors are closely watching developments in the Middle East. That's what everybody's doing right now after U.S. officials said they may be close to a deal that could help de-escalate the conflict and reopen the strait. Markets appear to be pricing in some optimism with oil prices falling, equity futures moving higher on hopes that energy supply disruptions could ease. Joining us now to discuss it all is Alan Small, Senior Investment Advisor at Alan Small Financial Group with IA Private Wealth. Alan, thanks for coming in. Always a pleasure, sir.
Good morning.
On a Monday morning with the sun shining here in Toronto, which is always nice.
Always nice.
And the sun's shining on the markets right now, too, isn't it?
Yeah, absolutely. And, over the weekend, we saw futures reacting late last night, even though the U.S. markets are not open. Obviously on the news that they're getting closer to a deal. Now, we've heard this many times before. It's funny to see the market still, I guess, gain some momentum off of that news. But I think overall, you have that positive news. Perhaps you have the tech trade, which continues to just boom ahead. AI and AI companies continue to report great earnings. We just got earnings from NVIDIA last week. The tech space is really driving the bus. And as you just mentioned, even here on the TSX, tech is doing well, as well as Celestica, a name that comes to mind that continues to do well as well.
So if investors just baked in that this is going to end eventually, Iran, like it's over here, but it's going to end.
Yeah.
Whether these talks happen or not, we're going to get to some point where it'll finish.
Well, I think you have to.
Just going on earnings and everything else is driving.
Absolutely. I think right now, investors are saying this will end at some point. Obviously, there's a lot of oil out there, a lot of reserves that countries have been tapping into. China, Japan, countries like that. Price of oil is moving up, obviously, over the last little while. Inflation, we got latest inflation reading. Still core inflation, still not moving up as much as what we're seeing on the headline number, which is a good sign. So that means, for the most part, I guess higher oil prices have not seeped into other parts of the economy, although I anticipate it will in the coming weeks. So I think there definitely is a push to get something done one way or the other. Either, as the president says, it's going to get done, whether we have a great deal or not a deal at all, in which case I guess they're ready to go back to war. So I think investors rather have the deal. Obviously, we all rather have some sort of deal, but we'll have to see what happens.
And the inflation is a big thing for, especially for Trump, with everything. They've got the midterms coming up, and he's promised he would lower prices, and so he doesn't want to see it. And the rates too. Right now, though, there's not much room for a rate decrease in the U.S., is there?
No, not much at all. And we're seeing the 30-year, the highest level since 2007 in the U.S., 30-year bond. 10-year is also has been creeping up. Come down a little bit recently, I guess, on the positive headlines out of the Middle East. But yeah, so higher bond yields, higher oil prices, higher inflation, higher costs in general. Not good, obviously, for Republicans going into the midterms in the next 6 months or so. They want to see a deal get done, but at the same time, they don't want to just say, okay, any deal and no nuclear weapons, obviously, is what they started this whole campaign with respect to. And I don't think they're going to move off that. And Iran keeps saying they're not going to give up the uranium. So they're at a standstill. And for me, it's difficult to see how they move forward. But according to what we've heard, the framework for a deal is in place. They're just working out the minor details now. So we'll have to see.
All right. In Canada, the big one this week, of course, the banks. They've been going gangbusters again.
Yeah, and it concerns me a little bit. You were seeing bank stocks like Royal, TD, trading at like 15, 16 times forward earnings. For me, that is high. There's no doubt about that. All the yields now are way down, 3%, under 3% for some of them. So for me, it's tough to get behind the banks at this point. I think you're going to see good earnings from them. I think they're going to say that they've increased their allowance for bad debts. They're going to say loan growth has continued to slow with the slowing of the economy here in our country. But I think, wealth management, capital markets, I think that's going to bode well for the banks. And I think they're going to come up with a good quarter. But the question is it good enough? I think the bar has been set really high. I have not purchased or have not put any more money to work in our banks. I've actually looked at U.S. banks, which have sold off, names like Wells Fargo, trading near 52-week lows, actually, down about 20% from the highs. I've looked there more so than our big banks here, because our banks have just been powering ahead, all-time highs, new highs seemingly every day, CIBC, BMO, Royal. So it's tough to get behind or tough to own or buy new at this point. I'm not saying you sell them, but I don't think you're putting new money to work in those banks.
What would you want to see to make them attractive to you?
I'd like to see, I'd like to see one of two things. Either earnings significantly move higher, so to bring down their multiples, or see a bit of a dip, right? I think you buy on the dip, of course, as we've done over many, many years. But it'd be nice to see if their multiples could come down a little bit. And that would only happen if we see significant growth, which I don't anticipate right at this moment, especially with our country growing GDP at around 1.5%.
And I want to get your thoughts. What do you think with Carney heading down to New York? What does he tell people down there? Because we've got all this new drama unfolding out west. What kind of questions do you think he's going to get, and what's he going to answer?
Well, I think he's going to get the question that he's been getting for a while now. What's going on between the trade negotiations? Can you build a pipeline to get that energy to the coast? The same questions I think that we've been hearing for years now. He's going to tout all our commodities, our natural resources as the place to invest money, bring business to our country. I've heard recently from the Premier, from Vic Fedeli himself, bringing $35 billion of new business to Ontario last year. Obviously, things are a little more difficult this year with trade negotiations, with the conflict in the Middle East. But I think they're going to say this is the place you want to be: stable growth, a stability in a world where it's not stable. I think that is what they
I know, but we have Alberta going. We're going to have a referendum question. Yeah. Will that play it all down in the States, or will they not even hear it? Do you think?
I don't know if it's going to play much in the U.S. I think we've heard rumblings of a referendum for a while, whether it was Quebec, whether now Alberta. I think they're going to focus on potential opportunities here in natural resources. I think that is what our government is going to push. And we have it here. Why not sell it? Especially with all the uncertainty out of the Strait of Hormuz. Why not come to our shores and get the oil from us versus take a chance in the Strait? So I think that's what they're going to push.
All right, got to wrap it up there. Always a pleasure, Alan. Thanks for joining us.
Thank you.
That was Alan Small, Senior Investment Advisor at the Alan Small Financial Group, evaluating private wealth. Coming up, our next guest says despite stocks being near all-time highs, markets remain range-bound as investors wait to see what higher energy prices will mean for inflation. That's next. Global stocks are getting a lift after senior U.S. officials said that the U.S. and Iran are approaching a deal that would lead to the reopening of the Strait of Hormuz. Our next guest says the markets are range-bound until we see how higher energy costs will impact inflation and what this will mean for the Fed's ability to cut rates. Joining us now is Jimmy Lee, CEO of the Wealth Consulting Group. Jimmy, thanks as always for joining us.
Great to see you.
All right, just how range-bound are they right now? What are we looking for?
Well, our upside target for the year is much higher than where we're at now. I think we're on the S&P 500. Our upside could be as high as 8,500, but that's on the premise that interest rates come down and we get at least one rate cut before the end of the year. So when I say range bound, I think in the short run, we've got interest rates climbing higher, which is my biggest concern right now due to fears of inflation and also the debt we have here in the United States. And I think those two things are hurting a little bit. But that being said, this market is really trading on fundamentals. We like the broadening out trade as interest rates come down, but we've said that buying tech, especially when it sells off, was a smart move. That's played out so far. But investors are also being more discerning about not just buying everything, as we've seen communication services sector not participating like the tech sector has. And so I think investors are being much more selective, and it's smarter to be active certainly than just passive.
And is everything about oil right now? Is that where all eyes are? And are you worried? Are people that we keep hearing they're pricing in that there's going to be an agreement or a deal of some type in peace? But what if there isn't? What's the concern there?
Well, I think we'll get continued back and forth like we've seen in the last 30 days if we don't get a deal sooner than later. But I think investors are past the oil shock. So I don't think it's just about oil any longer. And that being said, the oil shock is causing inflation concerns, which leads into interest rates being higher. So inadvertently, yes, it is about the war. I also think that there's a fight between analysts between whether or not the economy is slowing here in the U.S. or growing too fast. I think the other argument is that rates are higher because the economic data is heating up a bit. And so, I think that that could be happening also. Again, I'm in the view that we need rates to be lower. I do believe the economy is slowing a bit, but it is great to see the earnings being so robust as expected.
And what gives you the main reason for thinking that it's slowing?
Well, just anecdotally, if you talk to small business owners, if you look at the layoffs, if you look at, I know that we might get a nominal GDP print that's hot, but I think that underneath the surface, housing certainly is not moving the way you want to. And my thesis was that housing could be the one thing that really changes consumer sentiment, which happens to still be awful. But that still could happen. But I think it's now getting pushed out further towards the end of the year if that were to happen. So I think the economy has slowed a bit, but earnings have been strong, partially because job growth has been, not robust, and wages have been stable. So margins are expanding, which is what we expected. So we like the fact that technology is bouncing back. We like some of these sectors that are not participating as much, like financials. Worse in the cyclical side in terms of the sectors that we do like. So we do like the industrials, we like materials. We, again, like I said, I think we like tech on the dips.
All right. And excuse me, talking about the interest rates, the Fed, we've got the new head. Where does the Fed go here? Are they caught and they just have to kind of hold the line for now?
I think that I don't think we're going to see a rate hike. I think that would be a mistake. I don't think we're going to see a rate cut anytime soon. I think Warsh is sort of up against this higher inflation data that we're going to be seeing. And I think in the coming weeks, as your previous guest said, I think we're going to see a little bit higher print on inflation. We've got the summer months coming now with record travelers here in the U.S. hopping in their cars, and they're going to be feeling it at the pump. And so I think that's going to cause even more consumer sentiment to be negative. And so I think once we get past oil prices coming down, and that's what I would expect, I do believe that oil prices will come down sharply, and prices at the pump could come down sharply with it, and that will help change consumer psyche as well. But we've got trillions of dollars sitting on the sidelines when it comes to the markets. I think investors that have missed this big bull run since the bottom in 22 are trying to find their spots. And that's why I think small cap stocks are doing really well this year so far. Overseas stocks and emerging markets continue to get follow-on flows, which they haven't in a while.
Do you see that continuing with everything that's unfolding with tech?
I do, and which I like, which is the market's broadening out outside large cap U.S. I think, even though we haven't really seen a sustained rally in those areas, but I think we can. And I want tech to participate. And, our projection was that for earnings growth to be as robust as predicted before this year started, tech was leading the way, certainly. That's where all the growth is coming from. And so I think you have to be in the AI trade, but it's been good to see the second and third derivatives of the AI trade, those stocks kind of moving up in those sectors. But there have been a lot of stocks that have gone up very sharply in a short period of time. So I caution investors to not get too speculative and be prepared for volatility, which is what I would expect in some of these names that have really popped so quickly and so much.
All right, and going the other way, bonds, we were hearing a lot of talk about them. It seems to have faded a little, but are they still looming on the side there?
Yes, I think yields at these levels bode well for bond investors to get their feet wet if they're sitting in cash. It's still incredible just talking to people and how much money they have sitting in cash. Both retail investors and institutions are still holding a lot of cash, I think, even though it's come down. But there's a lot of cash on the sidelines to help bolster equity prices. And as we get these sell-offs, as has been the playbook for the last few years, investors have been buying the dips. In this year on the dip, I think it was more institutional investors, and the retail investors kind of missed out according to the data. But I think that buying on the dips will continue to be a theme, which will be smart. The stock market's up 2/3, 75% of the time. 1 year later, anyways, it's very difficult to be a short investor. I think this year, if we get consumer sentiment to change a little bit, we might get some animal spirits towards the end of the year, which could really force the market to melt up and then cause a little bit more volatility afterwards.
All right, we have to wrap it up there, Jimmy, but thank you as always for joining us.
Thank you. It's great to be with you.
Jimmy Lee, CEO of Wealth Consulting Group. Coming up, we'll take a look at some of the stocks on the move on Bay Street. Stay with us. All right, let's take you to Ottawa, where Prime Minister Mark Carney is speaking after touring a housing development.
We came together at this agreement, Premier Ford and I, to cut development charges in half. So what does that mean? It means up to $158,000 of reduced costs for housing here in Ottawa. Since that time, and part of the reason we're here is to see the good work of EQ Homes, but since that time, this company, this development, has seen sales go up by 65%. Gives a sense of both the demand for affordable housing, but also the impact of these measures. En même temps, nous avons lancé en septembre
we've launched in September with Mr. Minister. And at this time, we've concluded 14 agreements for more than 11,000 new affordable homes, really affordable. But it's not true. It's more than 14 agreements, and it's almost 15,000 affordable homes.
Started just back in September. A series of accords across this country, from Yukon, where the minister was yesterday, to Nunavut, where he will be later this week, to right here in Ottawa, where we agreed to build 3,000 affordable homes with the city of Ottawa. Overall, thus far, in less than 9 months, Build Canada Homes has concluded more than 14 accords, looking to build up to 15,000 homes just for those accords. There's a lot more in the funnel, so we're really getting the momentum there for this core objective of building affordable homes. So I just wanted to take the chance, and Marie-France, thank you for showing around your neighborhood, your riding, and I want to thank the builders and the developers of EQ for helping us fulfill this mission. So with that, I look forward to questions.
Good morning, Prime Minister. Marika Walsh with the Globe and Mail. Some critics are saying that the deal you struck with Alberta doesn't set a strong enough incentive for Alberta to stay in the program once it gets a pipeline, that they could easily just pay the $1.2 billion break fee and bail on the carbon pricing regime after they get a pipeline, similar to what we saw with Trans Mountain. How do you respond to that?
I'm not sure about the final point of your question there.
Well, the Trans Mountain pipeline, Trudeau approved it with the express intention of a carbon price and a cap on emissions.
So a couple of things. One is, let's start with the carbon price, which is that we have a carbon market in Alberta, and we have carbon markets across Canada that don't really work. They don't function as carbon markets. So headline prices, $95, $110, actual prices before we began these MOU discussions with Alberta, $20. So headline price 6.5 times, or effective price 6.5 times, where the market was trading at the time. So how do we turn something that was broken, didn't work, didn't achieve what was desired, into something that actually functions as a market? And there's several ways we're doing it. You referenced one of them. It's not a break fee, it's contracts for differences. These are contracts directly with entities that are building renewable power, clean power. So they're contracts. You don't break a contract as a government, certainly not in Canada. So that's $1.2 billion worth jointly between the two of us. The second thing we're doing is putting in place, Alberta has agreed to put in place a floor price starting from 2030. That will be a regulated floor. That means that credits cannot trade below those floor prices, and it's a rising floor. That will also contribute to the functioning of the market. I think the third thing I'd underscore is that this is an agreement. This is an agreement. It's not an MOU. It's not a memorandum of understanding. It is now an implementation agreement, a 50-page implementation agreement between the Government of Canada and the Government of Alberta. Governments, as I said a moment ago, in Canada respect their agreements. There is a desire to do several things, an intent to do several things, an agreement to do several things. That agreement includes building more conventional energy. It means developing a new industry, excuse me, of carbon capture, and it includes having a functional carbon market. And I will add one last thing, which that also creates the possibility of broadening that carbon market across Canada with willing provinces.
But that agreement expressly says that to get out of the deal, Alberta simply, or the federal government,
No, it does not expressly say that.
It says that it assumes sole liability. Alberta says that means they would have to pay $1.2 billion if they renege on carbon pricing. Is that not correct?
There are contracts for, I answered that question, if I may, already. There are contracts for differences which are struck for specific projects that would remove, projects to be determined that are going to remove or have low carbon and create, would otherwise create credits. That is part of several factors. That is one of several factors.
So there's no
that is part of the agreement. I think you might.
Next question.
Boris, pour le devoir, vous proposez une réforme du système d'approbation fédéral. Il y a 26 organisations environnementales du Québec qui disent que la paix sociale est menacée. Qu'est-ce que vous faites dire pour savoir la paix sociale? Oui, le système d'approbation fédéral.
Yes, the approval.
Oui, exactement. Pour tous les projets. Les groupes environnementaux du Québec disent que ça risque de nuire à la paix sociale. Qu'est-ce qui vous fait dire que ça va accélérer les choses et que ça ne va pas créer des manifestations, des gens chez nous, des poursuites qui vont ralentir peut-être les projets?
Premièrement,
demonstrations and people chained to trees. Well, first of all, we are in discussion with Quebec to have an accord for one project for approval, and we have accords like this with most provinces, and it will create responsibility, it will clarify responsibility. In this case, for Quebec, for approval, so most initiatives, most projects, so it's efficiency to have approvals at the same time, not sequentially.
Charles Toronto what do you think of the referendum question that Daniel Smith has asked? How do you see your role in this debate, and what do you plan to do to campaign for Canadian unity?
Well, let me start at the end, which is I certainly will be campaigning for Canadian unity. I've begun that, and part of the campaign is not a campaign, but it's actions. It's practicing cooperative federalism with Alberta, with Quebec, with all provinces and territories in the country, with Indigenous peoples as well. So it's moving the country forward, but moving the country forward with agreements and with parties aligned. So finding that common ground so we can move, and that's what Albertans expect. That's what Canadians expect across the country, and I'm pleased that the premiers are buying into this and moving forward on a number of fronts. So that's the first thing. And if I may just refer to my previous answer with respect to cooperation agreements, including potentially with the province of Quebec, that is an example of that cooperation. So that's the first thing. The second thing is, of course, being part of Canada brings many economic advantages, being part of our large market, being part of free trade agreements with 1.5 billion people around the world. But in the core, it's more than economic arguments, and I'm going to get to the first part of your question in a second. It's more than economic benefits. It's social. It's what we are as Canadians. So Canadians take care of each other. We take care of each other in our social programs. We take care of each other across different provinces. We look out for each other internationally, and this is a time where it's particularly important. What do I think of the question? In terms of the specifics of the question, we have an obligation as the federal government to look at the question and determine whether it's consistent with the Clarity Act that is underway. Ultimately, if there are questions around that, questions about the clarity of the question, if you follow, that would be a role for Parliament. I'm not saying that's the case, but we're just in the process of doing our due diligence. I will make the following observation though about the question, and this is an observation from experience. In these separation issues, it is often advanced that vote for this and it's a free option. Vote for this and we will strengthen our hand in a future negotiation. That is a very dangerous bluff. That is a very dangerous bluff. I saw firsthand what happened in the United Kingdom when the view was vote for this, it'll be soft, and then we'll negotiate, etc. And they ended up, and they're still 10 years later trying to undo what people didn't think they were voting for, but what they ended up having. Les Canadiens peuvent réfléchir sur les commentaires après le référendum au Québec.
After the Quebec referendums, when it comes to questions that are okay, it's the start of a negotiation. But for some, it was the beginning of separation.
There's a very strong positive case for Canada, a strong Alberta in a united Canada. We're making it stronger, working together, and I look forward to making that case with many other Albertans and Canadians over the course of the next 150 days.
My colleagues in French would love to hear that.
Oui, juste en français, plus longuement par rapport à la question. Qu'est-ce que vous pensez de la question, puis allez-vous faire campagne?
On réfléchit maintenant sur la question, c'est la responsabilité du gouvernement du Canada.
It's the responsibility of the government of Canada.
L'acte de clarté. Et s'il y a des questions sur la clarté, c'est pas évident.
Clarity, not easy questions, but we're doing the work now. Well, if there are questions, well, it's the
Radio-Canada. En avril, il y a une quinzaine de vos députés qui vous ont écrit une lettre pour vous exprimer des préoccupations par rapport à l'entente avec l'Alberta.
When it comes to the agreement with Alberta, do you think this is a constructive process? If so, yes, why didn't you take the recommendations in the agreement?
160 autres députés dans la
Well, there are 160 other MPs in the government. And second, there are suggestions, there are conversations. We always have them in a caucus in proper. Proper. It's necessary. It's important to have conversations, ideas, exchanges, but we need to decide in the end. Yes, there's an accord with Alberta, and there are implications for the British, the Indigenous population. So there are a lot of issues, and we need to think of different aspects. And we had a lot of progress. For example, when it comes to climate, with our electric strategy, which was shown after that. So we can do a lot of things at the same time. We can make Canada an energetic superpower with conventional energies and clean energies.
In a healthy caucus, you will always have an exchange of views, suggestions, and we have exchange of views of some members of the caucus perspectives. In April, of course, there's 160 other members of that caucus. We have to take decisions that are in the interests of the country, that reflect an agreement with the province of Alberta, the interests of British Columbia, the interests of Indigenous peoples, and also that looks at policy in its totality. And I mentioned in French the electricity strategy, which came out after that letter was sent, doubling our grid. We really underscored in that strategy the value of electrifying much of Canada, including obviously heating of homes and transportation, industrial production as well. Getting that right will have a huge impact on and a much bigger impact on our emission reduction. I would add as well our nature strategy, notre stratégie de la nature, $5 million, $5 million for nature strategy, as well as one of the only G7 countries who's maintained its commitment, which we also did after that letter, maintained its commitment to international development finance. So we have to look at everything in the round. We do many things at the same time. We're moving forward on climate action. We're moving forward on making this country more affordable, the focus of today, and more sustainable and more prosperous for all. Thank you very much.
Hi, Prime Minister. Tom Parry with CBC. Can I ask you, when you met with Danielle Smith, Premier Smith in Calgary, did you try to persuade her not to put a question of separation to Alberta voters in October? And I guess if I could ask as a second part, now that there is this question in place, how much uncertainty does it create for investors who want to put money into a pipeline or any other kind of project in Alberta?
Look, it's, I mean, the Premier has proposed this, the question and other questions with it. As I said earlier, Tom, we will look at, we will discharge our responsibilities, look at consistency of the question about a question, if I can put it that way, on separation, our consistency of that with the Clarity Act. So it is what it is. It's there. We have to discharge our responsibilities. As I said, look, the Premier doesn't always take my advice, but can I finish my please? Look, is it helpful to ask these fundamental questions? No, it's not helpful. Of course, it's not. Is it the democratic will of Albertans? Did they vote for this in the last provincial election? No, they didn't. It wasn't on the ballot paper. It wasn't in the mandates of or platforms of any of or of the governing party and the official opposition. It is what it is. It's I'll repeat that the core approach here and reality is positive. There's tremendous strengths that Canada brings to Alberta and Alberta brings to Canada. We are absolutely stronger together. We're better together. We're better people. We're wealthier together. My colleague Corey Hogan points out rightly that median wealth in Canada is 23% higher than the United States. It's not something people would think, but why is that the case? It's because we take care of each other. It's because we focus on things like affordability, because the people who live here will get childcare. The people who live here will get health care. The people who live here will get high-quality education for their kids. If they're retiring here, they'll get OAS and GIS because Canadians take care of each other. It's not perfect. Can it get better? Do we need to continue to work together as provinces and federal governments? Absolutely. Are we making progress? The Alberta Accord is one of many examples. You'll see many, many more. What Minister Robertson is doing with Build Canada Homes is in concert with the provinces. $158,000 off homes. That is because of work between the federal government, province of Ontario. Similar things are going to happen across this country. One of many, many examples of how we're stronger together at a time when the world is under enormous, enormous pressure. And, I'll finish with this, which is that you look around the world. I travel around the world. I see, and the world is in pain. Most countries don't think that they're headed in the right direction. Canada, with all our imperfections, challenges, Canadians think we are headed in the right direction. And part of the reason why they think they're in the right direction, we're headed in the right direction, is because we're Canadian, because we know we'll come together and we'll work to find a better way. And I'm committed, my government's committed to continue to do so. Thank you very much. Merci beaucoup.
You've been listening to Prime Minister Mark Carney, an announcement on affordable housing, but a lot of the focus was on Premier Danielle Smith of Alberta, her separation issue question. He said going to make sure it's consistent with the Clarity Act when asked about what he thought about it. And if he had asked the Premier during their meeting last week if he had asked her not to do it, and he said, well, the Premier doesn't always take my advice. He didn't feel it was helpful to ask questions like this, and Albertans didn't ask for it during the election. It wasn't part of the campaign. So we'll have to see what happens with that. But that was what we heard from the Prime Minister. Coming up, we'll bring you the latest headlines and we'll update you on the markets. The U.S. and Iran are inching closer to a deal to extend their ceasefire and reopen the Strait of Hormuz. Officials from both sides are signaling that they still need to negotiate certain points. U.S. President Donald Trump says the deal will either be great or there'll be no deal. A spokesman for Iran's foreign ministry says no one can claim the signing of an agreement is imminent. Tim Hortons is launching a campaign to recruit local team members. As the number of temporary foreign workers in its restaurants declines, the coffee chain says in light of high youth unemployment, lobbying for increasing access to foreign workers is no longer necessary. The newly launched hiring spree comes days after the Toronto-based company said It will expand with 80 new restaurants and 400 others going through some renovations. Uber is offering to take over Delivery Hero in a deal valuing the German-based company at more than 12.8 billion, US. Uber already owns 20% of the food delivery company. However, the proposal offers no premium to its most recent closing price. This may create an opportunity for rival bids, with DoorDash expressing interest in the company as well. Investors believe a higher price will be required to close the deal. And let's take a look at some of the stocks on the move in Toronto. We're going to start with the TSX and some of the biggest sectors moving today. Overall, we're looking at materials really soaring right now. You can see the TSX up by 0.88%, well into record territory, even inching toward 35,000. But the drivers today, look at materials up 3.11% right now. Financials also up by nearly a point. Energy, not surprising, being dragged down 1.3. It's off by right now with everything that is unfolding in the Middle East. Possibility that we may see a deal there, a peace deal. So some of the stocks that are moving to the upside. No surprise, America's gold and silver up 4.5. Aya gold and silver up by almost 5.7. And Montage Gold Core up by 6.4. Again, that's all on the metals moving today on the plus side. Now, going the other way, not surprisingly here either. Energy sector, everybody taking a hit there. Athabasca Oil is off by 3.51%. And Baytex Energy down by 3.16%. And Tamarack Valley Energy off by 3.4%. Virtually even the best performing on the energy index are actually in the red right now. Some of the best performing, there's a few that are up, but of the top 10, 4 are actually in the red. And BlackBerry, let's talk about that a little bit. It has been on fire for a while now and continues to make that nice recovery. This after a major U.S. government security certification milestone in the U.S. That's caught everybody's attention. And it's up again today, 3.77% right now. And BlackBerry for the year to date is up nicely after this little takeoff. It started in mid-April, and it's gone from, the lowest point was about $3 a share at the end of March, and it's now up look at that. It's up, that was $3 US, so it's up to 11.28 Canadian right now, up by 3.68%. Over to gold now, as we were talking about. Metals are moving up. You can see gold is up above 4,600 ever so slightly, almost up by a full percentage point in response to what's unfolding in the Middle East. And oil is going the other way. And WTI off by 5.5% right now and heading towards $91 a barrel. So we'll see where it goes for the end of the day. It depends on what happens with these talks in the Middle East as well, of course. Major Asian markets, they finished the day. Hang Seng was closed for a holiday. The Nikkei up, though. Look at that, nearly 3 points, well into record territory. CSI 300 also up by 1.58. Off to Europe. They are responding to that good news as well. Everybody is in the green. FTSE by 0.22. CAC 40 by nearly 2. And the DAX at the same point, 1.93%. It is up for the day. Coming up, we'll tell you about another major semiconductor maker that sees the chip shortage lasting longer than this year. Micron says the chip shortage could last beyond this year as demand due to the AI transformation causes supply to dry up. Earlier, we got perspective on this from the Micron president and chair, Sanjay Mehrotra, in a Bloomberg interview, but he began by discussing the company's significant expansion of DRAM manufacturing in the U.S., announced last week. Have a listen.
What today means, it really means, as you noted, bringing the most advanced DDR4 memory built with 1-alpha technology, which is critical for industries like automotive aerospace, defense, industrial, networking. These are critical industries that power America. And by us bringing this technology from Asia into now manufacturing here, it will help us quadruple our production here at this site in Manassas for their DDR4 memory. This is going to be huge for our customers in those key sectors. Memory today is absolutely key across all industries that have electronic systems. And Micron is, of course, investing in Boise, Idaho, building our leading-edge fab. That's for leading-edge memory that goes into smartphones, PCs, servers. And that leading-edge memory in Boise, Idaho, will bring first wafers out middle of next year and then ramp up from there on. We'll have a second fab in Boise, Idaho soon to follow that, start first wafers by end of 2028 there. And then we have production planned for Syracuse, New York area, where we'll build over time a mega cluster or 4 fabs. And you can see $200 billion of investments that Micron is making here in America to bring these long life cycle production that will be managed here in Manassas, Virginia, along with production in Boise, Idaho, and Syracuse, New York. And that will bring Micron's total production over the course of about next 10 years, as we ramp up all these multiple fabs, to about 40% of our production. By comparison, it is about 10% today. And all of that 10% comes from this site here in Manassas for Micron. And this will totally our investments, massive investments in long life cycle technology nodes, as well as leading edge technology nodes to serve these vast markets that are really surging in demand driven by AI. Micron is going to be bringing those investments, that's semiconductor manufacturing, and in the process, create 90,000 new jobs here in the US as well.
Well, on this point of demand and how this investment is seeking to help reach that growing demand, I'm wondering, how long do you expect the shortage of memory chips to last? When can we expect an easing?
Of course, the demand for memory has really surged, and that is because of the importance and the value and the capability of memory that is really essential for all advanced systems. And yes, there is a shortage, but Micron is working hard to increase supply through these projects here in America, here in Manassas, Virginia, Boise, and New York. And we see this shortage continuing beyond, well beyond 2026 timeframe. But the important thing is that Micron is working hard with our customers, working also on the long-term supply agreements with our customers to really ensure that they can have predictability for supply. And of course, Micron can have the confidence for the investments that we are really committing to here for the long haul.
Well, historically, memory is a cyclical business, right? Periods of boom, periods of bust. I'm wondering if a $200 billion investment here in the U.S. signals perhaps more of a confidence that that demand, that high demand, is going to be permanent, or are there concerns here that the industry could be overbuilding capacity?
Of course, what we are doing is building these fabs, which are very long lead time item. As you can see in terms of what we are doing in Boise and New York, it really takes several years just to construct the shell. How we equip that shell really very much depends on our latest assessments of demand at a given time. So important thing is to have that preparedness to meet the market demand. And memory has become a key enabler. It is a strategic asset for our customers today. It is a strategic asset for AI across consumer as well as data center industries, because without memory, you don't really have that intelligence that is critically important for the future roadmaps that our customers have. So memory is critical. Our investments, of course, will always be managed with discipline. Today, we are able to meet the demand of our key customers only about 50% to about 2/3 in many cases. And it's really important that we, of course, bring up this supply with discipline and continue to really fuel the growing demand, provide serve the necessary demand that is ahead.
That was Micron President and Chair Sanjay Mehrotra. Well, investors' attention will turn to the banks on Wednesday as Scotia, Montreal, National Bank all report results. Here's how the banks have done over the past year, starting with Scotia. It's been, for the most part, a pretty good year, and that has some people a little concerned for everybody. Look at some of these numbers. The Bank of Nova Scotia, 1 year performance up 55% right now. And other ones we want to look at, BMO. When you pull it up, again, same. Look at that, almost exact same spot, 57.88%. They're all up today. National, 65% is what it's up over the last year. And Royal and TD, I imagine we'll see similar numbers. Yeah, Royal, a little slower. I mean, it's a big beast. It's up 50%. And TD, and I'm just going to look at some of the things they might be looking for. TD, it's up 68%. Now, some of the things we'll be looking for from the banks when they're coming out, the credit quality, macroeconomic stresses are going to be concerns. Commercial real estate, we're looking for in some of their numbers. Regulatory and compliance pressures, these are all things that they'll be having to address over the next little while. Cybersecurity, technology risks, and competition and margin pressures as well. There's a lot going on. As much they're almost priced to perfection right now. Is there more room for growth, or might people say, maybe it's time we kind of sit back and let them go for a bit and see where they end up? But we'll be looking for those numbers on Wednesday and Thursday, of course. That wraps up this edition of The Open. Morning Markets is next.